Welcome back to our exclusive interview series, Market Mavens, where we bring you insights from the brightest minds in finance and investment. Today, we have a very special guest who truly embodies the essence of market expertise and financial acumen. Nilesh Shah, the Managing Director of Kotak Mahindra Asset Management Company, is with us today. With decades of experience in the financial markets, Shah has been at the forefront of India's investment landscape, steering portfolios through the highs and lows with market precision. Known for his sharp market insights and his deep understanding of economic trends, he has been instrumental in guiding countless investors towards financial success. Ladies and gentlemen, please join me in welcoming Nilesh Shah to Market Mavens. Mrs. Shah, welcome to Market Mavens, our special discussion on the market trends as we see right now. I'll take my first question to you right away. Given the current global uncertainties, do you think that India could experience a correction in the coming days?
So Sharmila, thank you for having me over here. And the rule of the market is never say never. Always unexpected things can happen. They can surprise us or they can shock you. So I wouldn't be surprised if there is a correction in the market. But I will be shocked if the correction is very deep and persisting. That looks unlikely to happen.
So, continuing with that, given the current situation, how do you suggest investors position their portfolios to brave any ups and downs that may be coming their way in the coming months or so?
So first of all, my submission to investors will be a long-term investor in India growth story. There is a watch called Patek Philippe, and they advertise their watch saying that you never actually own Patek Philippe. You merely look after it for the next generation. I think Indian equity meets that category. You don't own equity or equity mutual funds in India. You merely look after it for the next generation. Number two, if we see last 20 years return on broad market, roughly it is around 13% big figure. Last 4.5 years return is 21% big figure. And before that, 15.5 odd years were about 11% big figure. Clearly, going forward, you will have to moderate return expectation. One, inflation is down, so nominal returns will decline. And two, the base is reasonably valued. So be a long-term investor and with moderate return expectation, follow the dharma of asset allocation. This is fairly valued market with some froth in micro caps and small caps. Maintain neutral allocation and keep some dry powder in your portfolio to buy during correction.
Great tips, and you mentioned something about froth. So, talking about retail investors now, what according to you are a few mistakes? You already pointed out quite a few, a very myopic or short-term view of the markets and etc. But what are some other glaring errors to your mind they are committing on which they can well avoid at this time?
So many retail investors, Sharmila, follow momentum investing. Whatever has run yesterday will continue to run today. Please don't make that mistake. If valuation goes up, it can also come down. This is time to buy quality, not momentum. Second, many investors go leverage into market, into derivatives like futures and options. For an ordinary investor, trading is injurious to their financial health. 1 out of 10 may make money trading, 9 out of 10 are likely to be loser. Please remember, For an ordinary investor, there is no future in futures and options market. Number three, many a time people have unreasonable expectations. They expect their stocks will rise after they buy and fall after they sell. Please remember, market is far bigger than everyone else. There's no way one can predict what's going to happen tomorrow. So be a long-term investor, follow the dharma of asset allocation, and be a regular investor. The proverb of little drops of water make an ocean applies in regular investing. Don't put all eggs in one basket applies through asset allocation. And jaldi ka kaam shaitan ka applies for long-term investing.
Fantastic. Talking about future again, we know how artificial intelligence is getting involved in the way markets are predicted. Do you think AI will have a role in fund management, like how AI is already being used in health, for instance? Do you see a future of AI getting more and more involved in non-biased fund management? What is to your
Undoubtedly,
mind?
yes. It will be fair to say, Sharmila, that a fund manager using AI and machine learning is more likely to outperform a fund manager who is not using it. But
Okay.
will AI drive the portfolio? Answer is no. There will be blend of human as well as AI together in managing money. If I read balance sheet on my own and punch the data, I will make errors and I will take longer time. Through machine learning, I can do that task in 2 minutes. Undoubtedly, machine learning will help in crunching data. AI will help in analyzing that data. But finally, it's the human being who will have to take the call. So I will say AI will play a significant role, but it is human with AI which are likely to do better than AI alone or human alone.
Right. There is a very upbeat sentiment about India becoming one of the largest global market investment destinations. It's already among the top 5. But do you think that it can become the biggest by beating some rivals like China?
So, from an economic point of view, China will be significantly better than us, significantly bigger than us. They are already 6 times bigger, and that lead will narrow down but not going to get bridged. Now, today, the gap between our market cap and Chinese market cap is not as wide as it is between our economy, which means we are getting valued 3 times more than China. If Chinese companies make 100 rupee profit, it gets valued at about 900 rupee. If Indian company makes 100 rupee profit, it gets valued at roughly about 2200, 2300. We are getting higher valuation because market believes will deliver better growth than China, which I think will happen. Our governance standards will be superior to China. And most importantly, the sentiments towards India are likely to remain more positive and will get reflected into liquidity. It's the combination of growth, governance, and liquidity which will keep Indian valuation ahead of China. Now, will it remain 3 times more, 2.5 times more, 2 times more? I don't know. But certainly, India will continue to enjoy premium valuation over China.
Nilesh, you just said that people should not be in the game to make quick bucks. But we see, despite a lot of misgivings, people, especially newcomers, getting extremely enticed by F&O. So, what is your word of caution, or what is your take on futures and options? If one has to participate, what should be the right bent of mind? What is your piece of advice to people who are exposing themselves to F&O risks?
So, one, if you want to swim, then you need to learn swimming. Maybe 1 in 1,000 people pushed into swimming pool will swim on its own, but 999 are likely to drown unless until they know how to swim. Same way it is trading. If you want to trade, then please learn the tricks of trading. Reading WhatsApp message, following Telegram channel, that's not training. Trader has to be wedded to stop loss. Investor is wedded to averaging. As trader, learn about stop loss. As trader, learn about managing your exposure. Don't bite more than what you can chew. Trading is, continuously on the screen. You can't be roaming around while your positions are open. So trading is a very, very hard way to make money. If you want to play that game, then first learn the rule of the game. Don't have exposure more than what you can afford, because things will go wrong at the most unexpected time. Follow the rule of stop loss. That's very, very critical for your survival. If I see some of the best trading people in the world, trading firms in the world, they follow stop loss to the hilt. They have a lot of computing power. Their algorithms are fantastic, and they have a lot of data analytics capability. If you are going to fight against these people with better connectivity, better data analytics, and better algorithms, you really need to be good at your game. Otherwise, investment is much easier way to make money.
So, talking about cryptocurrency, with Donald Trump making it a campaign statement, do you think crypto is again going to raise its head? And what are the risks of, or what is your perspective on crypto investments in India? Should it be a part of people's portfolio? Your general view on the matter.
So, crypto is an asset class, it's not currency. Currency is what is backed by the sovereign guarantee of the government. Crypto is not backed by anyone. Number two, there is no way to identify fair value of crypto. It believes in greater fool theory. If I have bought crypto at X price today, I believe there will be another person who will be buying at higher level from me. The day I believe that no, I will be able to sell it only at lower price, the crypto magic will disappear. Now there are staunch supporters of crypto, but think of it, there will be many users of crypto who want to stay out of the radar of central banks and investigative agencies. It allows you to move money across the borders without getting caught by the regulators. Will regulator allow this to flourish over a long period of time? Number two, storage of crypto is a risk. As per one report, 30% of bitcoins which were mined have now disappeared because of hard drive crash, because of password misplacement, and so on and so forth. So the price what you are seeing is only on 70% of the Bitcoin, which now covers 100% of market cap. If you invest in Bitcoin, please ensure that it is stored properly, else Bitcoin prices may go up, but you will not make any money like those 30% unfortunate holders of Bitcoin. Third, this is an unregulated market. There is no guaranteed settlement. There is no regulator to whom you can go if you are cheated. The transaction costs are enormous. So please be aware that this is not a regulated market where you can go to regulator for safeguarding your interest. Now, if after all this caveats you are interested in investing, trading in cryptos, please ensure that your exposure is such that even if it goes away, if it disappears, you will be able to take that loss.
Nilesh, what every investor wants to know from someone like you is, what are the undervalued sectors where funds can now be parked to reap benefits over the next 5 years? If you have some insights on that as well while we speak on the markets.
So, Sharmila, I will say this is fairly valued market, and you are unlikely to get a very, very cheap sector. Yes, you are likely to get what we call growth at reasonable price valuations. We believe technology is one sector where valuations are trading below or around historical averages. And companies which are recruiting people who can use AI tools are able to deliver cheaper, faster, better solutions to their customers. And many Indian IT companies are leveraging AI to deliver such solutions to their customer. We believe at current valuations and keeping in mind companies' ability to leverage AI tools, tech sector is something where one can pick up bottom-up stocks. The second sector is consumer FMCG. For last about 18 months, consumer stocks have not performed well because consumption per se has remained subdued in rural India, in mass market products. We believe with election, good monsoon, and coming festival season, consumption has a good chance to bounce back, and that should be reflected into select consumer stock. Obviously, companies which are innovating on product, on cost, and distribution are likely to be beneficiary.
Right.
The third sector, Sharmila, where I believe there is next 10-15 year run is precision engineering. If we read transcripts of companies like Google, Apple, Tesla, Microsoft, they are talking about robotics as the future growth area. Now, we don't have companies which can produce robots, but we have many companies which can provide components for robotics. Indians are known for precision engineering skills, and I believe over a period of time, there will be many Indian companies which will become preferred supplier for robotics component all over the world. Such companies will provide you not 1 year, 2 year, 5 year investment view, but maybe 10 year, 15 year kind of growth opportunity. So I will say keep a watch on precision engineering, especially one which is trying to cater to futuristic industry like electric vehicles, robotics, and so on and so forth.
Right. Talking about mutual funds, which is a very important domain for you as well, do you think that there is a regulatory framework in place, but it needs some tweaks or some changes? What is your take on that?
So if you are playing a game of bowling, you need guardrail to ensure that your ball goes in the right direction. The regulators like SEBI provide guardrail to the industry. And it is thanks to regulation we are able to earn investors' trust. There are so many Ponzi schemes which are not regulated. What's the experience of investors over there? And how much scale size they can make? Cryptos again is unregulated market. What kind of investor protection and governance will be there is anybody's guess. On the other hand, mutual fund industry has grown to 60 lakh crore plus. We manage trust and confidence of more than 5 crore customers. That's all possible thanks to SEBI's regulation. Any industry which has to grow will require regulator. Thanks to RBI, banks are growing. Thanks to IRDA, insurance companies are growing. Thanks to SEBI, mutual funds are growing. We need regulators or referees in the game which we are playing.
Right. Nilesh, two things about young people experimenting with the markets. One are the millennials who like to, take risks. The other part of this young group are the young fund managers who, on your footsteps, want to aspire to become, experts in the field. To both these components of the young entrants in the markets, what is your piece of advice as we conclude this conversation?
So, one, there is no free lunch in the world. Other than your parents, no one is going to give you free lunch. There is risk and hence there is return. To all the young millennials, my advice will be four. One, please follow income minus savings equal to expenses rather than income minus expenses equal to savings.
Wonderful.
Many people want to borrow on credit card to spend or invest. That's not the right way. Second, little drops of water make an ocean. Be a regular investor in market. Don't waste your time trying to predict where markets will go. Number three, be a long-term investor, because if you want good juicy mango, you need to wait for a dozen years after planting mango tree. And number four, don't put all eggs in one basket. While you do have risk-taking capability, you still need some amount of anchoring in your portfolio to withstand volatility. Divide between debt, equity, real estate, and commodities like gold based on your risk appetite and investment objective.
Thank you so much for such valuable insights on how to invest, where the market is going, and more. Nilesh, it's always a pleasure
Thank
to
you.
have you on board with us. Thank you so much.